Good morning everyone. My name is Sandeep Guhe, student of SAS Institute, second year. Today I am giving presentation on merger and acquisition and my topic is leverage. Introduction. In a finance, leverage gearing in a United Kingdom and Australia is any technique involving borrowing funds to buy things hoping the future profit will be many times more than the cost of borrowing. It's called as a leverage. Meaning, financial leverage results from using borrowed capital as a funding sources when investing to explain the firm assets base and generate returns on risk capital. Leverage is the investment strategy of using borrowed money, especially the use of various financial instrument or borrowed capital to increase the potential return of an investment. Factor affecting the financial leverage is financial liability, financing decision, interest rate, stability of the firm, return on assets, fixed financial costs. Second stage leverage. Leverage and types. There are two types: financial leverage, operating leverage. In financial leverage, there are a debit component, and in operating leverage, there is a fixed component. Difference between the operating and financial leverage. Operating leverage and financial leverage. In operating leverage is related to the investment activity like capital expenditure and decision. Financial leverage is a more concerned with the financial matter, capital structure or debt equity mix. The fluctuation in the EBIT can be predicted with the help of the operating leverage. The changes of EPS due to the debt equity mix is predicted by the financial leverage, as you can see in diagram. Why is a financial leverage is important? Financial leverage is important at is create opportunities for investor. The opportunity come with the risks, and it is often advised that new investor get a strong understanding of what leverage is and what potential downside are before entering leveraged position. Example of the leverage: a company was formed with the 5 million investment for the investment investor, where the equity in the company is $5 million. This is the money the company can use to operate. If the company use debt financial by browsing $20 million, it now has been a $25 million to invest in the business operating and more opportunity to increase value of the shareholder. Limitation: if the winning investment are the amplified, so are losing investment, use leverage can result in much higher downside risk. Some result in losses greater than essential capital investment. On top of the brokers and contract traders will change fees, premium and margin rates. Even if you lose your own trade, you will still be the hook for extra changes. Advantages of the leverage: investor and the trader use leverage primarily and amplify profit. Winners can become exponentially more rewarding when your essential investment is multiplied by the additional upfront capital. In addition, use leverage allow to all access more expensive investment options that you would otherwise have to had access to with the similar amount on unfunded capital. Leverage can be used in short-term, low-risk situations where high degree of capital are needed. Thank you.